Japan isn't just another economy. Japan is the largest foreign holder of US dollars and US Treasuries, and their economy has been under serious pressure. If Japan is forced to change course, or worse, sell US assets, that creates ripple effects that hit Americans directly through inflation, higher rates, and market volatility. To understand why February 8th matters, we first need to understand how Japan got here. For decades, Japan hasn't had an inflation problem, it's had a deflation problem. Deflation means prices fall over time. That sounds good as a consumer, but it's a nightmare for governments because falling prices crush asset values, wages, and economic growth. For decades, Japan hasn't had an inflation problem. It's had a deflation problem. Deflation means prices fall over time. That sounds good as a consumer, but it's a nightmare for governments because falling prices crush asset values, wages, and economic growth. To fight that deflation, Japan went all in on stimulus. Massive money printing, ultra-low interest rates, and not just low, negative interest rates. Negative interest rates flip the entire system on its head. Instead of being paid to lend money, lenders actually lose money. Borrow $1,000, pay back $900. It sounds insane, but Japan did it anyway. Why? Because the biggest lender to the Japanese government wasn't private investors. It was the Bank of Japan itself, the central bank. And when the government says print and lend, the central bank listens. For years, they justified it by saying deflation made it necessary. But that justification is gone. All that money printing is finally catching up, and now Japan has an inflation problem, not a deflation problem. And that changes everything. Now the Japanese government is at a crossroads. The Prime Minister wants more money printing, but to do that, they need approval on February 8th. If that approval doesn't come, stimulus may slow. If it does come, inflation risks grow even larger. Either way, markets are watching. And here's why this matters to the United States. First, there's something called the yen carry trade. Japan has had the lowest interest rates of any major economy in the world. That allowed banks, hedge funds, and institutions to borrow yen at essentially 0%, then take that money and invest it into U.S. assets like stocks, crypto, and real estate. Borrow at 0%, earn 5 to 6% in U.S. markets. That's free money. This trade has been a massive source of demand for U.S. assets over the past several years. If Japan raises rates or pulls back stimulus, that trade becomes less attractive, and that means fewer buyers for U.S. stocks. Second, Japan's housing market is extremely sensitive to rates. Roughly 79% of Japanese mortgages are variable rate. In the US, it's under 10%. Japan is now facing the highest interest rates it's seen in roughly 30 years. If rates continue to rise, homeowners feel it immediately. Higher payments, tighter budgets, rising defaults, the same dynamics the US experienced during the 2008 crisis. That creates stress inside Japan's economy, and in a global system, that stress doesn't stay local. Third, and most important, Japan owns roughly $1.2 trillion in U.S. government debt. One reason Japan bought so much U.S. debt is simple. For years, U.S. Treasuries paid more than Japanese bonds. Even a few percent looked attractive compared to negative rates at home. But if Japanese interest rates continue rising, that advantage disappears. And if Japanese investors decide to shift money back home, the U.S. government suddenly has a problem. Fewer buyers for its debt. When demand for U.S. Treasuries falls, yields rise. And when yields rise, everything gets more expensive. Mortgages, car loans, credit cards, and government borrowing itself. That's why this matters. We don't know exactly what Japan will decide on February 8th, but we do know this. Changes in Japan's bond market and money printing have already caused volatility in U.S. markets multiple times over the past year. And keep this in mind, Japan already has a debt to GDP ratio of around 240%. That's double the United States. Their debt problem is worse than ours, and now they're debating printing even more money. So what does this mean for you? It means the global financial system is shifting. Japan is moving away from decades of deflation, changing how its economy works, and even restructuring how companies operate. Historically, Japan had a stakeholder-first economy, focused on employees, customers, and long-term stability. Now it's shifting toward a shareholder-first model, much closer to the U.S. system. That shift creates risks, but also opportunities. There are investors already positioning for this through Japanese stocks, ETFs, and international diversification. And zooming out even further, this is the bigger takeaway. Over time, investors win in this system, not because they time everything perfectly, but because they stay diversified and stay invested across cycles. Stocks, real estate, precious metals, crypto, businesses, markets move, economies change, policies shift. But diversification lets you adapt instead of react. You don't need to predict every headline. You need exposure. If you want to learn how to think like an investor and identify opportunities before they hit the headlines, I've put together a free investing masterclass. I walk through the exact framework we use to analyze markets and spot trends early. You'll also get access to my investor briefings completely free. The link is in the description. And if this breakdown helped you, the best way to support the channel is simple. Share it with someone who needs to see it. Because what happens in Japan doesn't stay in Japan, and the next move is coming.